Today's topic for the day is the number one thing you should do before you place a single income trade. And with that, I won't delay any longer. Jack and Norman, take it away.
Hey, first of all, let's give it up for DA again.
Really, and the
Thank
box
you.
tops, the letter.
Producing it.
I just ask Alexa. I can't say it, otherwise I'll turn her on. But it's 1 minute and 57 seconds, so you'll have that extra. But
Right
I
on the
tell
nose.
Paul Simon, they don't make music like they do, but it's hard to find. It's different kind of music, but it's so nice and soft. You've got some good selections there.
Yeah.
Glad to hear it. Thank you, guys.
All right, Norm, what's on your mind?
Well, I was looking at the non-event today with the reports. They didn't seem to do much. I'm just looking at my house price. I think if inflation is taking off in the real estate sector, even though it seems to be struggling in a lot of parts of the country. I'm just amazed that you have the kind of action that you do have with interest rates the way they are. I just think that all of that is confusing me today and confuse the markets. They don't seem to be taking much direction today. A little softer, but not enough to say it's going to do anything to stop this bull run we're having.
Yeah. The thing with real estate that I'm seeing is older people, middle-aged and older, they don't want to give up that low interest rate they have on that mortgage.
Yeah. Careful now, Jack. Careful.
They're not going to sell when they got a 2 or 3% mortgage rate and sell and then have to go get a 7 and tell the banker, oh, we'll refinance when the rates come down. In the meantime, they're stuck paying $7,000 a month because of, anyway, that's the thing. Older folks don't want to get out of that cheap interest rate mortgage and sell that house. So there's no inventory.
Well, and they're willing to do it if they get that kind of extra money up front to pay that difference for the next 10 years. If they ask another 10% and somebody's willing to pay it, that's enough to make the deal.
Yeah. I jacked mine up when I sold it for 14% over what it would.
Well, you jack everything up.
I do.
So.
I know.
So listen, there's a lot of, it's funny because although I don't personally concentrate on options, I've run option firms in the past, as we've talked about before, but there seems to be a lot of interest lately in options from the standpoint of the way you can design options to eliminate a lot of the risk. I mean, everybody wants to get in, but they think they're too late now in the stock market. But they think they're talking about how there's going to be a big leg up right now. I mean, what's your view? What do you tell people who say, I'm a little bit scared to get in, but I know I should, but maybe I'll wait for a pullback? What do you do there?
You don't do anything. You don't do yourself any favors by waiting. If you're afraid to get in, you're talking about too much money to put in. You should only put in what you can afford to lose in the stock market. And it's not saying you will lose it, but that's the mindset you have to have so you don't have any fear, right? It's like going to Vegas. Maybe you take out 3 or 5 or 30 grand and you fly to Vegas, and that's money you can afford to lose. Not like the stock market is gambling in no way, shape, or form. But stock prices can go down. Anything can and will happen in the market. The other thing I would say is, if you're afraid, is why are you afraid? What is your fear? I coined a new term that I'm very proud of a couple of weeks ago.
Well, let me get my pencil. Okay, go ahead.
Okay, so you heard of fear of missing out, FOMO, right? Now I coined this one called fear of getting in, just what you just talked about. Fogey. Fear of getting in. They want in, but they're afraid to get in. And one of the best things they could do right now is if you're going to get in, is just look at what you could get for a covered call. Because the CBOE wrote a letter to the SEC and was explaining how a covered call is actually less risky than owning stock. So because you lower your cost basis, but the best part about it is you bring in income. So talking about like real estate, I have Google, 2,000 shares of Google, and I look at it, it's like a house that I just rent out every month. I'm never going to sell the stock. I don't care if it goes from 123 to 117 to whatever. I'm just constantly bringing in 3 to 4 grand a month, selling covered calls against that. So I think of it like real estate. I'm renting out a house, although this is way better than renting out a house because you don't have to go try to buy a house, first of all, to rent it out. And when you buy a house, the liquidity is impossible. It's so hard to sell a house. You got to wait for the appraisal, for the loan officer, for all this other crap. With stocks, in 1 second, you could sell $1 million worth of stock. You can't do that with a house.
Well,
So-
with covered calls, you got all that middle ground of small, from a nice fat grab to a smaller amount. Sometimes you're only making a couple of ticks, but I mean, if you own the stock and you sell the premium up here,
Yeah.
you're taking that cash in. Now, if the market backs off, you're losing money. You're losing money in your stocks, but you're offsetting it by what you collected.
Yeah.
And in order for you to actually lose money, that thing has to go down to a point where you would probably be putting your stop. So,
Yeah.
you
Or
know,
not.
what's the hesitation?
Or
It's
not
just
do it at all.
learning about it,
Yeah, I don't recommend people, your break even on a covered call is your stock price minus the amount of premium you brought in. That's your break even. So you can always buy back the call and sell the stock to get out of it. But I don't recommend doing that. If you pick the right stock in the first place, and that's always the main point. We'll get to that a little bit. But consider this. I know 2 guys one guy in particular, he owns Apple at a cost basis of 0 because he's been selling monthly covered calls on this thing for years.
Wow.
Right? So now imagine that you own Apple for free. I don't know any other way you can own a stock for free, right? And
I see what you're saying. If you add up all of those premiums you've collected, it adds up to the value of the current value of the stock.
Yeah, Sam's saying you lose your upside, but you don't because you pick a strike price that's 7 to 10% above your cost basis or your purchase price. And if you get called out 7 to 10% higher in 1 month, that's abnormal. You should get called out. So you don't give up any upside. You're using it as an asset to create cash flow and income. And that's what this is all about. So that's the first place I would start, is for people to look at what stocks you got now that you have 100 shares of, or you want to get to 100, and then look 30 to 40 days out for expiration, and then pick a strike price 7 to 10% above your purchase price or your cost, and you're good to go. And if you do that in that time frame, you can do it 11 to 12 times a year, which I think is just perfect.
Well, I was looking at our topic today, and the thing that popped up for me, a lot of new is basis. Is the how much is the stock? There are a lot of traders out there that look for the low end stocks and look for, if you have a $10 stock and it goes to $11, you've made 10%. Why pick a stock that's $500 and expect it to go to $550 to get the same percentage return? Where's the measure when you're looking at the right thing to do? Is that part of the number one thing to do?
The number one thing is it's all about the stock. That's the most critical component to any option strategy, is the underlying stock. It doesn't matter what option strategy it is. It's all about picking the right underlying stock. And for me, that on a straight up covered call, that has to be a stock that's in a really good trend. Like when I look at a trend, I want to see a 6-month trend. Like Meta has been in a great 6-month trend. Elf Beauty, I don't know what they do. They're in another great trend. I don't do any fundamental analysis. I don't care what the company does. I just want to see that 6 months trend is preferably been making higher highs, chugging all the way up. And then that's a very stable way to get in, is if you have already that 6-month chart, and then you apply an income strategy to that stock. That could be a covered call, a credit spread, naked puts, which are amazing right now.
So you're relying on consistent price when you're looking at these stocks, consistent upward motion to define the value of the stock, whether it's good or bad. You don't care. You don't look at earnings per share. You don't look at, no, nothing.
Oh, look at that.
I mean, except for the, knowing that, I mean, listen, we all, anybody that's a student of Stocks 101, they say the stock price today is the culmination of the value, you know, what it's perceived the value to be, plus what possible out a few months. That's the value, that's what you're seeing right now. And any new information is going to move that value around.
Yeah, and I also believe that everything there is to be known about a stock is already priced into the stock. That wasn't the case prior to the internet, where Wall Street may have known more things about it than the public. But with the information overload that's out there now, everything is priced into the stock. And one thing I want to address, I saw, I don't do leaps. The guy was saying, you know, buy a leap for next year out and use that instead of the stock to write a covered call against that leap. That's not a good idea. The reason is because you never, ever want to do that. And the reason is when you're buying a leap is not a substitute for buying the stock. The reason is because the option, any option has time decay that's already built into it. So you're buying an ice cube that's melting in the sun to sell another ice cube that's going to melt in the sun, right?
For those who don't know, a leap is a very long-term, for all options, years.
Yeah, years. Long equity, whatever, leap. They make up these acronyms, but it's an option too. And I don't recommend anybody ever really buy options. That's the most speculative thing. And if you do, you only want to maybe put 1 to 2% of your account into a buying a call or a put, whereas you can use 80% of your account to buy, you know, a great stock like Apple and write covered calls on that till the cows come home. So leaps are not, you know, everybody wants to find a shortcut on a great strategy, and buying a leap and selling a covered call on that, that's fancy and tricky, but it's not a good idea. The other thing is if you buy a leap, you don't get any dividends from a leap. You know, I like to only write preferably covered calls on stocks I already own that are paying dividends. You ain't going to get that on a leap. That's a guys that invented that. They want to find a tricky way to skin the cat, but that there's no substitute for buying the stock and selling a call.
Well, I think the shorter vision you have, the more current fact you have, and therefore the more control you have over what you should be doing, as opposed to considering. I mean, look what's happened in the last couple of years.
I know.
I mean, you could have bought puts on it a couple of years ago and felt pretty good about it. It leaves it, you have nothing now. Where it looked great before. So, I mean, you don't want to go too crazy with that, but I know that you like weekly options. So let's combine what the number one thing is. It's important before you approach an option or an option process. I know that you combine options, and we can talk about that a little bit more detail in some other time. But the idea of the number one thing that you need to do, what is the length of time that you like to deal with?
I'll stay with a stock. When I was originally trading individual stocks directionally, I would have this 2 to 10 day time frame for a trade, and I was trying to pick up $2 to $10 in that 2 to 10 day time frame, and I would stay with that stock as long as the trend wasn't broken. So, like, I would start off with a stock that made a new 52-week high. That's like the best starting place. But just because it made a new 52-week high is not enough reason to buy it. It could have been popped up on news. It could have been a takeover or a bid on, whatever. I want to still see that steady 6-month trend. But if it's making new highs also in that, that's even better. And then on top of that, it has to trade on a major exchange. Of course, it has to be optionable. For me, when I used to keep a trade journal, I didn't do well on stocks trading stocks under $15. So I prefer the little more higher price stuff, and trade at least 500,000 shares a day, and of course be optionable. That's kind of my criteria for stock picking. And I got a software program that does all that for me, shows me support and resistance. So I use that support and resistance to pick the strike prices for the stock also. Like with naked puts, that's paying off so high right now. It's sick. And what I do with there is I'm finding a stock that's in a great trend like Microsoft or ELF or whatever. And then I'll go down to where that support is, even 10% lower than where the stock is now. And I'll sell a naked put right there. And you get that cash hits your account instantly. And most of the time, people are so afraid of naked puts, but I can tell you from experience that if you're picking the right stock, and again, that's the main part, you'll have a hard time having the stock put to you. I did a little case study where I was trading Archer Daniels Midland, and I wanted this stock to be put to me so bad. So I first started out selling naked puts 10% below the price. I couldn't get it. And I wanted this one. I wanted it to be put to me. So then I would go like 5% below the stock, and the stock would go up. I wouldn't get it put. And it's great. You collect the premium.
You're not getting your way and you're collecting premiums. It's nice.
I wanted this stock. So then once I got it, I could collect the dividend, write covered calls, use the dividend and the premium to buy more stock. But, people think, oh, I don't want a naked put. I'm going to have the stock put to me. Well, it should be one you want to have put to you, but you'd be shocked at how hard it can actually be to have it assigned to you if that thing is in a good trend. I did it on Devon Energy so many times. I mean, imagine selling naked puts 5-6 times. You got all that premium. Then you finally get the stock assigned to you, but you made all this premium. So your cost basis is really lower than what you had the stock assigned to you at.
Or you can buy more stock with it.
Buy more stock. And the other thing that's crazy is one time I did have a stock assigned to me and on Friday, and then the next Monday, it jumped up like $3. It went down like, $3 or $4. I had it put to me, assigned to me. Then Monday, it jumps back up $3 or $4. I had a huge profit right there because I got the profit from where the market is and what my assigned price is minus the premium I had received on selling that put. So it turned out to be a monster profit.
Okay, so the number one thing is you've got to find the right stock, and the right stock, the major part of that definition, right stock, is to identify a stock that that is in the right trend. That it's in it's a beautiful trend that's been around a while. Okay, so you've identified that. When do you pull the trigger on it? Do you pull the trigger as it comes, say, on a long, if you're looking at calls or taking advantage of a market going up? Do you wait for the corrective action against a support, and if you don't, do you adjust your position sizing? I mean, how do you pull the trigger?
Well, I just pull it. I don't wait for I don't wait for stocks to move up or down because I don't believe in timing, and I don't believe in tripping over 25 cents. It's going to hold me up because the stock needs to go down 25 cents before I can pull the trigger. I don't want to wait. I'm not the kind of guy that wants to wait. Like I believe, that technical analysis is used to react. So when I see a stock that's trending higher, I react just simply by buying that stock.
I mean, do you feel better about a stock that when you wake up in the morning, you want to trade Meta, and you're looking at the stock and it's actually come down the last couple of days, hasn't broken the trend, still in a nice upward trend. Do you feel better about it and therefore increase your position size, or do you always take the same position size each time?
Yeah, it depends on how much of the stock I have. Like with Google, I have 2,000 shares, so I sell 20 contracts, bang, right every month.
Right.
Options expire Friday. The next Monday, I just sell them. I don't sell 5 here and 5 here and 5 here and 5 here, or 10 here and 10 here. I just sell the whole 20. Now, when I bought this just happened to me. I got called out of Google. We have a class on this. I got called out around, I don't know where it was, 115 or something like that. And the next time, once I got the stock assigned away from me, called away, then the following Monday, I just went in and bought another 2,000 shares at the market. And it turned out to be like 123 or something. But it doesn't matter to me what the price is, because I'm taking the long way home on this trade, right? So I ain't going to trip over the stock going up, down $2 or whatever. Over time, and I've proved this a million times, it's almost impossible to lose if you do this right. You lower your cost basis every month, and then eventually you get called out and you got that profit right there.
Wow, Dave, if you listen to that, just go ahead and pull the tunes "Long Way Home" and the other two, It Don't Matter to Me. Let's use those as an introduction for the next time. And this way people will know that it's Jack coming on, because
Will do.
it
Will
don't
do.
matter to me.
You got the best music
That's right.
titles,
Yes.
man. I'll tell you. Yeah, The Long Way Home.
Yes.
Yeah, I got that from an old mentor of mine. You know, everybody wants the shortcut on a trade. Everybody wants to shortcut or hack or this or that. And he just says, Jack, I go, how do you do this? What's your time frame? He goes, I'm taking the long way home on this, right? Means he'll trade it for a year or more. Right?
Hmm.
I can't even remember when I started selling Google
Yeah.
covered calls. This was back before the split, but the long way home.
Yeah, apparently you say it's going so well, so long. I wish I had a leap. You never say that. That's good. But okay, so okay, you've defined you want the right stock in the right trend. So listen, there's in this market, there's a lot of stocks with the right trend. So what stocks are you looking at now when you wake up in the morning? I know the commodities that I look at when I trade commodities. What are the stocks that you look at?
Well, that's funny you say that. I don't, most people, as I mentioned before, they log on to their brokerage account, and what they're looking at automatically that pops up is the P&L, right? When I wake up in the morning, I could care less about the P&L on my Freedom portfolio. I'm just looking at how much cash flow does this thing throw off every month, right? So if I got 10 stocks in there, how much am I making every month off these 10 stocks? It's the income, not the capital appreciation. So that's what I'm looking at. So, I got Google, Apple, NVIDIA is amazing covered calls, Fortinet, FTNT. One other little trick you can apply to that stock picking thing is to make sure that the stock preferably has a beta of over 1. So
yeah, I was going to mention about the beta. That's that's what professional traders are looking at.
Yeah, or just for regular guys that don't know what it is, beta is the amount that an individual stock moves relative to the broad market. So the broad market has a beta of 1. So ideally, you'd want to find a stock that has a beta a little bit over 1 if possible, but not all of them do. I got McDonald's, J&J, AbbVie, a whole bunch of them in that Freedom portfolio that have just great options. AbbVie has great options too. So that's my time frame is forever.
Mm-hmm. So J&J, wow, that used to be so. It should be like
I know.
this.
McDonald's too. McDonald's will be at 300 soon. That was a stock I think I mentioned before that I bought my oldest boy Jack when he was 7 years old for his 7th birthday. I bought him 7 shares of McDonald's because I think it's important that you push this financial literacy all the way down to kids. You got to start teaching your kids about the market. And he's reinvested these little tiny dividends, and he's 33 years old now. He got that stock when he was 7, never sold it. He'll never have a profit that big the rest of his life, and he learned so much about it. So, I encourage everybody here to write some covered calls on stocks they own, and also, teach kids about it. You can buy a slice of a stock like Tesla through Schwab for $5 and gift that to a kid just to teach them a little bit about the market. Yeah. But
I always like it when the local school will call me. When you come in and tell them a little bit about trading and what that's about.
Yeah.
The eyes they're looking like this. Because these kids want to. They're all about making money.
It's so
I was never about making money when I was in high school.
I was a little bit, but I didn't know anything about anything.
I was all about making out when I was in high school. Making money.
So I was on with Jeffrey Turnmeyer. I don't know if you know this guy. He's brilliant.
I know Jeff.
He's unbelievable. And he was telling a story about his first experience with dividends was when he was on the bus, and this kid had candy and nobody had candy. He's in Kentucky, I think, and nobody had candy on the bus route. This kid had candy, and Jeff's like, how'd you get this candy? He's like, oh, my dividend check came in, so my parents let me take this dividend check and they cash it for me, and I get to spend that dividend. And that just drove him crazy. This kid's getting free money, right? Actually, think about having corporate America working for you. What if you
Wow.
could live off dividends, right? So that was his start into the market. Dividends are just a great thing. You know, my little Jack, my grandson, I don't know if I told you this story. I think I did tell you this, no?
I don't
About
think
my
so.
my grandson's investing philosophy. So I'll tell you, he's at my house. We have him for the summer most of the time, and he's always following me around, and we're always getting in all kinds of trouble. I let me drive my truck, and his mom was furious at me. But aside from letting him drive the truck and have a puff on my cigar, we were looking at the computer one time, and I'm showing him this stock, and I said, "This is a really good stock." And he says to me with kind of a snarky tone, he says, "How do you know?" And, you know, I thought, this is the best question in the world. I said, Jack, anytime anybody talks to you about finance or stocks,
Give him
ask
that
them
question.
that, how do you know?
Yeah.
So then he's looking at the quote and the beta and the PE and all this stuff. And what's all this, Pop? And I tell him, and I say, here's the thing you want to focus on is this dividend. What's that? I said, well, that's it's money that they pay you if you own the stock out of their profits. So then his whole philosophy, every single time we'd look at another stock, the only thing he would say is, how much does that one pay you to own it? That's the most beautiful sentence in the world. You know, how much
Yeah,
does that stock pay you to own the stock? Wow.
you
This
know,
kid,
it's, you know, there's a lot of, you know, that's the axiom, the corollary is covered call it, you know, you're getting paid to play the game, really.
Yeah.
But in our, before we end this today, the one thing you need to do is identify a stock in a strong trend.
Yep.
And you've named several of them. We talked a little bit about beta, which is important. You want a stock that's moving. And so
Yeah.
if it's over one, it's at least it's beating the market. Is my final question to you is, you know, everybody's always looking for the highest beta because they want the most money. Where's the limit that, I mean, if it's a beta of 2.5 or 3, do you start to get nervous or?
No, I don't. I never get nervous. But it can be pretty wacky. I'll tell you, the other day I was talking to a guy about beta, and he pulled up, you know, you can just do a Google search and find the stocks with the highest beta.
Right.
And there were some ridiculous stocks. It made like banks, you know, just little banks and just weird little financial companies that there was no reason other than a lot of times beta can be high because traders can push it around a little bit, right? So that's why the beta, it's the stock still has to have, you know, half a million shares minimum average daily volume so that it cannot be pushed around, right? Apple is the hardest stock in the world to push around because of the volume. So
Should I sell my GameStop? Is that what you're saying?
man, I never get into those memes. If you have GameStop, really?
No, I don't have GameStop. But you mentioned pushing around the stock. But
AMC and GameStop, those are just horrible. I feel so bad for people that get into the market, you know, trying to get rich quick. That's just, that whole, what was that thing? Wall Street bets or something? Yeah.
don't know. That's the kind of thing David knows. You know,
Yeah, I don't know.
yeah.
They all gang up on short squeezes or some other ridiculous strategy. But oh, there's DA.
Speaking of short squeeze, that was your nickname, wasn't it, David?
That was my cue to come on. Yes, gentlemen, thank you. Great show. We have, let's see, we have at least one question here that we haven't gotten to in the chat. Jack, do you use support and resistance numbers when you issue the WOP trade?
Yeah, I don't issue the support and resistance number itself, but like right now we're doing bull put spread. So I'm trying to find a put that's deep out of the money on a stock that's trading way higher than that. And I'm going to use that support line. And that's where I'm going to start on the options chain. It's not always perfectly aligned with that option, but sometimes you got to go a little bit higher than that. But yeah.
Excellent. And
resistance.
I believe you covered this already, but it popped up again, possibly after you covered it. Just read the question. When selling covered calls, if the strike is 7 to 10% above your cost basis, is below the current stock price, could you get assigned at that price and lose money? In other words, paying the difference between your strike price and the current stock price.
Okay, say that one more time.
So let me just, I think it might have a couple extra words in here.
Yeah.
So I'll read it slowly. When selling covered calls, if the strike price 7 to 10% above your cost basis is below the current stock price, could you get assigned at that price and lose money?
Yeah, you could. You can get assigned anytime, but most of the time it's going to happen on that Friday of options expiration. But here's the thing on that. If you own a stock and you're down on that stock and you want to sell a covered call 7 to 10% higher than the current market price of the stock, if the stock goes up and you don't want to be called out at that strike price, you simply buy back the call that you sold.
Right.
And you're out. But most of the time, if the thing's down, you could get assigned, but you can always prevent yourself from being assigned by simply buying back the call if it is in the money. If it's still out of the money, just leave it alone, let it expire worthless. But once it's in the money or gets close to being in the money, if you want to get called out, leave it. If you don't want to get called out, buy back the call that you sold. Right. That's all you got to do. And then you can just sell another one another 30 days out as soon as you get out of the one you don't want. So there's so much flexibility with that. It's unbelievable.
Excellent. Excellent. Listen, this show has been fantastic.
Yeah.
Thank you for all the knowledge you shared with us. One last thing. Can you just mention some of those stocks that you said were fantastic trending right now? I caught NVDA, but that was the only one I caught.
ELF has been amazing. I haven't looked at it today. META, awesome. FTNT, I don't know how that trend looks, but that's a powerhouse covered call stock. And it's not as expensive. I think it's less than $80 FTNT. So, you know, for $8,000, if you bought 100 shares of an $80 stock, it would cost you $8,000, or it cost you $4,000 if you bought the stock on margin. You buy it on margin, you sell a covered call, your yield is twice as high, right? So you got that going for you. Now, I want to just leave them with one little thing. Is next week, can't do it next week because I'm on the first vacation I've had in 20 years. But the week after that, I want to talk about naked puts. Write that down, and everybody come back and have your questions ready. I get so many questions about naked puts, and there's so many myths about them that DA, please.
And I'm going to lobby that we don't wear shirts on that day. So we talk about naked puts.
If you don't wear a shirt on that day, don't come on the camera. That's all.
There we go. Come on.
Excellent.
I can do what Adam does. I don't show up at all. It's good.
Thank you so much, guys. Appreciate everything you've shared with us. I'm going to cover some of the bullet points that you've hit for the folks that are watching, but feel free to sign off. And as Jack said, he's going to be off next week, so we won't have a show next week, but we will return on August 3rd, Thursday, August 3rd.
I'll see you in a couple, Jack.
Bombard me with questions on the 3rd. So write them down, have them ready. We got 2 weeks for you to prepare. And we're going to have a pop quiz after that show, pop quiz. All right. Adios.
Fantastic. Thank you, gentlemen. All right, let's see. Chock full of information. I was going crazy here trying to take notes. I'm sure I missed some stuff, but some of the most important things that I got was that Jack warns against buying a leap, which is an extremely long dated option, and selling covered calls against that. He says for 2 reasons, at least 2 reasons. It's like buying an ice cube to sell another ice cube, and that's melting in the sun. But also you don't get dividends like you do when you buy the stock. So there's no substitute for buying the stock and selling the call. Another important thing he said is probably the most important thing he said the whole show, the way that he picks a trending stock. The best place to start is a stock with a new 52-week high, but that's not enough reason to buy it because it could just be news or takeover bid. So you also want to make sure that you see a stock in a steady 6-month trend, one that trades on a major exchange, one that is highly optionable, and the stock is at least over $15. You don't want to trade anything low dollar amount. Also must trade at least 500,000 shares a day. And very important, he actually went back and added this in. It should have a beta of over 1, which is the beta is the amount that individual stock moves relative to the broad market. When someone talked about being put a stock, if you sell a naked put and being put the stock, he said it should be a stock that you want anyway. So you don't want to be selling naked puts against a stock that you don't want to end up with. So pick a high quality stock, see the list that we just covered. I'll put this in the recording. By the way, so I did see in the chat, somebody asked, is the recording available? Yes, it will be. Just go to here. Let me drop it in the chat. It's going to be jackcartertrading.com/new show. Right now that redirects to this Zoom chat that we're in right now, but a little bit later today, it will go to the recording of today's show. And ultimately, we're going to have all of the recordings for all the shows on a single page. So we're working on that, but for right now, a little bit later today, today's recording will be available on that jackcartertrading.com/new show. Let's see. One other thing that I caught, teach kids about the stock market, gift them shares. He gifted his son or grandson shares of McDonald's. He's now 33. And as he said, he'll never have another profit like that again. Next time, Jack wants to cover naked puts. So load up on questions, bring those, drop those in the chat next time. And that's about it, folks. Remember, Jack is off next week, so we won't have a show next week, but stay tuned. 2 weeks from today, Thursday, August 3rd, 12 p.m. Eastern Time. Join us again for a talk about naked puts, all the myths surrounding them, and I'm sure how you can use them to your advantage. All right. Thank you for joining us.